So you can start.
Fine, thank you. Morning, everyone. Hope everyone is doing well and taking the necessary precautions during the COVID side. I'm Vijay Veer Singh, representing Amity Innovation Incubator and your host for the today. Thank you for joining for a very insightful series on A to Z of startup investments. Before I introduce you to speaker for the day, let me give you a very brief introduction of Amity Innovation Incubator. We take pride in introducing Amity Innovation Incubator as a very comprehensive startup ecosystem that exists in India. We started our operation way back in the year 2007 under the aegis of our Honorable Chancellor Dr. Asim Chauhan sir, with a vision to ensure that a comprehensive ecosystem is in place to nurture entrepreneurs and strengthen the innovation culture at grassroots level. We are supported by Department of Science and Technology, Atal Innovation Mission, Niti Aayog, and Ministry of Electronics and Information Technology. So far, we have handholded and supported more than 500 ventures and had invested in 55 ventures through Amity Capital Ventures, which is our investment vehicle, with dozens of exits so far. We have a dedicated space of more than 45,000 square feet for incubation center at our headquarters in Noida, with physical presence in 7 states and 17 virtual locations in India and abroad. We have been providing the soft lending platform for our incubated startups who are looking to scale their operations outside India through our international presence. For more information on incubation and funding support, do reach out to us. I'll be sharing you the credentials shortly in the chat box. Now, with respect to today's session, if you are an entrepreneur looking for investment for your early stage startup, you may wonder, what is my company worth? How does an early investor value a startup? The answer to these questions can be quite difficult to formulate. Most valuation are negotiation, a balance of setting a price that is acceptable to the founders, but also agreeable to the investors. We, as a part of its 3-session series on A to Z of startup investment, we are organizing the first session on valuation and fund raising for startups today. There is no general rule of putting a price on a startup. However, our speaker for the day, Mr. Addison Appu, VP Investments at Thinkuvate, will share some tips that will make your valuation and fundraising process easier. Addison leads Thinkuvate India operations and looks after the deal flow, investments, investor connects, and portfolio management across Southeast Asia. Key sector focus includes health tech, fintech, agri-tech, IoT, cloud, AI, ML, deep learning, AR, VR, and infotech. He has led pre-Series A investment in companies like Renticle and Signcatch. Addison has also worked with the investment banking team at HSBC in India and Hong Kong, where he was involved in international and domestic transactions across diversified sectors. On the behalf of Amity Innovation Incubator, I thank you for accepting our request for today's session on valuation and fundraising. Over to you, sir, and I'm sure all the participants might be looking forward for a very interactive session. Thank you.
Thank you, Vijay. Thanks for that kind introduction and very useful. Good morning, everyone. Thanks for taking up time for the session today. My name is Addison. I work for Thinkuvate currently. I handle investments across Southeast Asia as well as India. Can we quickly go to the slides, Sahil? Yep. So we can move. So Thinkuvate is a Singapore headquartered VC. We are an early stage tech investor. We invest in companies which are into technology and technology enabled. 8 portfolio investments so far. One of our companies is now listed on the Australian Stock Exchange. So it's a technical exit for us. We usually come in at an early stage, pre-Series A, angel, seed. And we look across life cycles of a company, and the focus area remains B2B or B2B2C. We haven't done anything B2C yet, but a good opportunity comes along and we can have a look at it. Ghanshyam and Ritesh, if you can move to the next slide, please.
That is a little louder.
Yeah, sure. So Ghanshyam and Ritesh are managing partners at Incubate. I lead the investments across Southeast Asia. We also have a pool of venture partners and advisors who are working for multinational corporations at a very senior level. So we come across deal flow across Southeast Asia from countries like Singapore, Vietnam, Indonesia, Malaysia, India, Israel, and we look at opportunities across the board. So from a tech perspective, anything that is new and that is emerging, we are quick to spot and can give you a great feedback. My own background is, as Vijay pointed out, work for HSBC and currently handling investments at Incubate. Can we move to the next slide? Our investment thesis is typically early stage, seed angel, pre-series A. We also have a democratization model where we not only give you the money, but also help you to grow into Southeast Asia. We help hand-holding, go-to-market strategy, as well as help you to negotiate uh, good contracts and help you in fundraise as well going forward. So basically, if your product market fit is ready, we can help you to move into the different geographies as well. Next slide, please. This is our sector focus. So we are looking for opportunities in health, fintech, education, consumer tech, and also natural resources. This includes water. This includes rare earth material, as well as little bit on the battery technology as well. Anything, any startup with artificial intelligence or blockchain in the core. So typically, if you look at it, we are an early stage VC, and we are looking and scouting for opportunities across Southeast Asia as well as India. In terms of other horizontal techs, blockchain, NLP, cybersecurity, virtual reality, and augmented reality is our area of interest. So this is a very brief macro background about us, who we are, and in the investment check size, I will also give you the investment check. The first check is usually about USD 200 to 300K, give or take, where we also allow other syndicate investors to join us along with us. We invest via from Singapore. So it is a investment holding structure for us. All the investments that we do are in a holding structure format. So that is the brief. Happy to connect with you one-on-one later with your investment pitches. So if we can move on to the topic for discussion today. Valuation is a very tricky subject. When I say tricky subject, because you don't know what the correct value of a business can be, could be, and should be. There are various methods to determine this. As a VC, and I have been part of private equity and investment banking prior to this, and have looked at mature models where you have distinctive cash flows, where you can predict some part of the business in terms of revenue and the EBITDA, and that is an easier way to go about it. But when you come to startups, it's a green field. And when I say green field, some are at ideation stage, some are at no revenue early stage, some are at proof of concept stage, some of them are at very early revenue stage, and then you get the little mature businesses which have got significant traction and can raise money from larger investors. So if I go step by step, what are the different methods or approaches for valuing a company, and for that matter, a startup? So the best plain vanilla way is to look at what is your future valuation going to look like, and how do you arrive at that number? The easiest way is to multiply your volumes by the price of a product that you're going to sell or a solution you're going to sell, and that is nothing but the sales projection. In certain companies which are purely B2C and are into e-commerce or something of an aggregator marketplace, we look at the GMV number as well, but that is not the revenue that the business is going to make. That is the amount of transaction that is going to take place via the platform or the website. So that is an indicator of the traction you have created, but that does not mean that that is the revenue that you're going to generate as a business, which is going to support your own general and administrative expenses, which includes infrastructure, team, as well as technology cost. There is also within the sales projection, we come up with the concept called an ARR, which is nothing but your monthly revenue multiplied by 12. So last month's revenue, which you multiplied by 12, a lot of people speak about ARR numbers. ARR numbers is basically if you have done, say, 1 lakh sale in the month of March 2021, so your ARR will be 12 lakhs for the next period. However, this number keeps changing month on month because if you are growing as a business, if you add 20% growth month on month, your next month's number will be 1,20,000 and not 1 lakh. So the next month's ARR will change to 14.4 instead of the 12 lakhs that is perceived as of today. Most of these startups talk about this, but that is subject to how big the market is and how fast the startup is growing. The larger the traction, the faster the number grows. There are also app-based businesses which completely work on the metrics of downloads and monthly average users and registered users. This is not directly in line with your valuation. It is an indicator how much traction you have created in the market. People often come back and say, I have so many users, but are they paid users? Some of them don't even pay. In a country like India, just imagine if you are using a WhatsApp and you are asked to pay $1 a month, how many people will end up using it in the first place? I mean, we are not even talking about the privacy policy that is going around, but just $1 a month, if you are asked to pay, which is 74 bucks as of today, how many people will be using it? So registered users, monthly active users is a great indicator of the usage, but it is not a great indicator of whether the business is sustainable or not. You may be using it because you're getting it for free, but as soon as you're asked to pay for it, you may not be able to see the similar traction. So you need to think about good products and good services, which where there is a demand for it and people are willing to pay for it. So in terms of projections, when I talk about future valuation method, this is purely based on sales projection, your GMV numbers, your average revenue, annual revenue rate, downloads, MAUs. These are metrics. You find out a way to value a business. Then there is the cost to duplicate method. Think about a situation where you want to build an Amazon and you want to create a B2B marketplace where resellers are connected. The best and the quickest dirty method is how much money Amazon had to put into the business over these last 20-21 years to build where Amazon is. That is the quickest and the dirtiest way to calculate how you build scale, how you want to do it at an early stage. So I cited this Amazon example because you can see the life cycle of a particular company. But when you're talking about early stage startups, suppose I have say $1 million and I put into that business, even you have a head start into that business, you have started say 3 months before me, I can quickly wipe you out because by the time you raise money, I can actually get good talent on board. I can replicate your product in no time and I can go to the market. So that is a very dirty way of calculating a value of a business, that whether I can replicate it very fast or not. So this method is done when we actually this gives us a process of elimination rather than a process of selection, because if I can replicate a business, it is quick to eliminate it. Then that means it is not a long-term winner. So this method is usually used for that particular purpose. When we come to the third method, and this is the most commonly used methods among VCs, is the market multiple method. But this has got a intrinsic flaw. What happens is you compare a company which may be at a different life cycle, maybe addressing a completely different market need, or it may be at a stage where either it is growing at a very early stage where the growth is super annual growth, versus a company which is much more mature and maybe at Series D, Series E, where the market penetration is almost getting to a saturation level. So it has got its intrinsic flaws, but it is the most commonly used method for startups, where you compare between two businesses, you look at numbers, what company X was at point Y and what the company Z was at point A, and you compare the notes and say, okay, this company raised money at X multiple of sales or X multiple of revenues, or it was given, say, 10x of its EBITDA multiple. So this is a fair valuation. So if you're doing, say, suppose your average monthly annual revenue rate is say $1 million, and by thumb rule I pay 7x of your sales, then I will value you as a company at pre-money stage of $7 million, and then you raise whatever you raise and get to the post-money level. When you talk about transaction multiples, those are a little different versus a going concern. A going concern or a trading comparable is where the company is still into its identity business, where it has not sold to anybody. But when you're talking about transactions, suppose Baiju bought over White Hat Junior, so it paid a money which was value of the business plus a premium. So that happens when you are actually putting a number where you are discounting it for the future value it is going to generate. So suppose your value is 10 as of today as far as the current valuation is concerned. But if I buy you out and add your business to my business, if I can grow 2x, I can give you another zero point 0.5 on top of the 10 million that I've given you upfront. So current value of the business plus premium gives you transaction value because it has got a premium associated with it. The fourth way, and which is the most, I would say, large businesses, mature businesses use this method. It is very difficult to do a DCF for a startup because DCF is completely dependent on future cash flows. When I talk about future cash flows, it is the money that you are generating after your operational costs are met. So if you have 10 rupees revenue and to run the business, you are spending say 8 rupees, then you are generating a free cash flow of 2 rupees. If you are doing so, then in that case, you can run a DCF where you calculate the present value of the future cash flows. You use a discount rate to bring it to the current number and current year or current stage of the business, apply a growth rate, and put a risk premium to it to get a value of the business. This is a very structured way. All the valuation books are written on the basis of a discounted cash flow, but as the world changes and new emerging techs come in, it is very difficult to do a DCF at a very early stage because most of these businesses do not generate ample revenue. Even if they do, they don't have profits. Profits even at an operational level, forget about the net profit level. So DCF usually works when there is operational cash flow, when you are making operational profits. So the 5 critical factors where you are actually measuring or valuing a startup, the 5 factors are the business model. So we look at the business model from a VC perspective. We look at how you are enabling the business model, whether tech is playing a larger part of it. Because if it is a tech-driven business, it is easier to scale. Think about or imagine a situation in the COVID times. All the businesses which were heavily dependent on brick and mortar suffered a lot because they were not able to operate in the first place. Because of the lockdown, physical mobility was shut down. There was no transportation, no logistics, and you had to pay a rental on for your shop, which was not generating any cash flows. So business model tech plays a critical part. And the third most important part is the team. It is good to have a great horse, but it may not win you the race. And we always cite this example: the jockey is as important as the horse. You cannot win a race with a one-legged horse, but you can't win a race without a good jockey, even if I'm giving you the best horse of the race course. We also look at early tractions, and which goes back to the future projections and your GMV growths and your ARR growths, and of course the growth prospects. So if you are making money on every dollar spent, you have got great growth potential. If you look at all the businesses, and of late there has been a viral WhatsApp message which is circulating across social media platforms, where you see all the big guys who have raised tons and tons of money making no money for themselves. A lot of them are showing huge losses. It's all expenses driven businesses where you have created traction. One intrinsic thing that you got to keep in mind is, if you're going for a B2C model, you will have to spend a little more in order to ensure that people adopt a particular tech or start using a particular app. So there is always a push that you have to do. When you have created a good product, be it anything. Once you start getting pull demand, that means people are ready to pay for it, even if it's not coming for free. So that is something that you have to keep in mind. Can we move to the next slide, please? Yeah. So this is another question that comes along, and when we are discussing it, certain ideas are brilliant. Some startups approach us with the ideation stage, where they just have a business plan or they have just put something together on a piece of paper. How do you value that? I mean, like pre-revenue startups, what is the value I can give you? Even if you have come to me at a seed round, or say at an angel round, the considerations that I have to look at is, first and foremost, who you are. The first thing that I come across is whether you bring something to the table. Do you have experience? Do you have the desire to be an entrepreneur? Because believe me, it is a trend to be to do your startups, but it is very difficult to sustain it when there is a no check at the end of the 30th day of each month, and when you have to meet and foot your bills and you don't have money, then you suddenly feel, oh, I would should go back to a job and start working rather than doing this startup thing. It is glamorous. You see the success stories, you see people coming on television giving interviews, but seldom do we see the hard work that has gone in for, say, 2 years, 5 years, 6 years, 8 years, in certain cases 10 years. You saw a Flipkart now being acquired by a Walmart. How many people knew about a Flipkart in 2008? And whether you would have gone and got a job there, you would have said, no, I would work for a PNG or a Unilever and not a Flipkart. So the trends are there. So first we see is the background, the founder's background, whether he has done this before, whether if there are two of them, whether they bring skill diversity. Then of course the most important factor is, if you're starting up, you must cater to a need. There must be a demand for the product and the solution you are building. If there is no need, you are reinventing the whole process, you're not going to get a traction beyond a certain point, if at all you get it in the first place. Then of course there is the competitive landscape. People come up with very similar ideas. Everybody's doing a marketplace for edtech, everybody's doing a marketplace for social commerce. You Google is there. Go and search whatever you're trying to build, whether it is addressing a serious problem, whether there is a market demand for it. If there is no demand for it, don't start. You start something where there is potential possibility. It's a probability game. You got to give yourself a 50% chance. When you flick a coin, it goes up into the air. The 50% probability that is ahead, or 50% probability it's a tail. At least have a 50% chance of succeeding in what you do. Don't just go and copycat models. uh, of course, we also look at prototyping and proof of concept. If you build something, try it out, try and sell it. If you've done one prototype, look for a buyer. You see whether he is willing to pay for it or not. If he is willing to pay for it, an investor will be able to finance that. But if there is no demand for it, if there is no willingness to purchase it, if there is no willingness to use it, then how do you convince an investor to put money on that? Of course, then there is the market effectiveness. There are different places where there is emerging tech. You come up with an idea which is supported by some new technology, which is collecting data which is not readily available. Then of course these all things also play a huge part in valuing a startup which may or may not have revenues. We do look at startups which have no revenue, but the probability of getting funded at a very early stage is still very low in this environment, because everybody wants to look at least a proof of concept, or whether you have got certain relationships. Three things are very critical. Either you are having a strategic relationship with a larger player which has got very deep pockets, which is called financial leverage. Otherwise, you should have great technology which is cutting edge, and you can ensure that competition cannot get through in the next 6 months. Or the third thing is basically you have a great team and you have already started creating tractions. Other than these three factors, it is very difficult to come to an investor and tell you, boss, why should I invest into your business? So if I look at it, or the way VCs look at it, we have always put a weightage on certain factors. For a no revenue startup, how do we value it? How do we value a business which is not generating revenues? I gave you the methods where when you are generating revenues, I can perceive a value, but I'm also trying to understand and tell you how we perceive a business when there is no traction, no revenue in the first place. So usually the team gets the maximum weightage. It is about 30%. If you are coming from, I'm not a firm believer in IIT IM stuff, but as long as you gotta have the passion and you must understand business. Two geeks, not sure whether they make a great team. One geek and one business guy usually make a brilliant team, because the techie can actually ensure that he cracks the right codes, and the guy who has a business acumen can then sell it. So usually that combination is, it works the best. But when there are two people who are too obsessed with what they're building, they usually end up forgetting how to sell the product. And if there are two people who are just selling the product and don't have a great product, they also get into trouble. So team does play a huge part when you are starting up. Of course, market size, which pertains to again the demand side of the business. If you're building something, just see to it that there is a potential demand. Yeah, if you can tap it, then there's a higher probability to grow the business much more faster. And of course, there is product and technology. There is competition. You must look at competition. You should never fear competition. You should not shy away from talking about competition, because if there is competition, there is a probability that something better you can do which is not available in the market. So I firmly believe that competition is good. That means there is market validation. That means people are doing something when there is demand. If there is no competition, it's a complete greenfield area. You don't know whether you are doing the right thing or not in the first place. And of course, your growth is also dependent on future fund requirements. So we'll also look at it. If it's a cash burning business, it's a gas guzzling business, very difficult to get funding, because I mean, you yourself may be one of the persons who have spread the WhatsApp viral message where people are not making money, be it the Paytms of the world or the Khata books of the world or the creds of the world. They have got crazy valuations, but they're not making money for themselves, neither for the shareholders. It's a perceived market value that they have created for themselves. So of course, I mean, if there is a huge fund requirement, that means that you're not build something which can operate or sustain on its own. And that is not a great way to think about it in the first place. So I'll stop here. I think I have given you most of the citers. I will be very happy if you can make this session interactive, and happy to field in questions you may have. Vijay, we can go to the Q&A.
So I would request the audience to type in their questions, or they could raise their hand so that we could allow them to ask questions.
Audience can raise their hands, please. We'll unmute you guys.
We have Abhishek Sahu. Will unmute you.
Hello.
Yes, Abhishek, you're audible. You can go ahead.
Yes, sir. Good afternoon, sir. Thank you for giving me this opportunity. Sir, I'm a first year law student, and sir, me and my friends have started an initiative actually. It's a kind of ed tech where we are providing practical skills like communication skills and group discussion skills. We conduct it on a weekly basis, and we are thinking that we should do more of this and we should scale it up. And sir, so I wanted any valuable suggestions from you. Can you please provide?
Uh, EdTech, community-based EdTech it's catching up. People want to get their questions answered, but if you're doing it for a very niche play, then of course you will have a very limited audience. If you're going it for a larger scale where multiple stakeholders are involved from different fields of work, then of course then you'll have to ensure that the sessions are as interactive as possible, and people spending an hour should get value for it, right? You should not go and have just general chit chat. When you're talking about building knowledge, you've got to share it, and share it in the right forum, I believe.
Yes, sir. Thank you, sir.
We'll unmute Nidhi now. Nidhi.
Hello, hi. Thanks for giving this opportunity. It's very nice talk you are providing. It's very knowledgeable. Actually, I have started my own with name as Khalifa Academy, and we are providing a solution for education and positive development of children. So we are dealing in parenting, teachers training, and life skills development of for children. uh, till now we are doing by own, right? But I have not did any registration in Startup India or Skill India, anything else. So if I want to raise fund, or if I want any investors for my venture, so I need to register on these circulation of government, or I can apply directly.
Uh, Nidhi, usually getting a DIPP registered startup helps you from the future perspective. It will give you some tax holidays, some rebates, certain
Okay.
certain waive offs, which helps you as a business in a very early stage. But it is not a mandatory thing to raise money. When you start up, the first and foremost thing is whatever you have developed in terms of a product or in terms of a solution or a service, you should be able to get early traction in terms of users as well as customers. If you get that, that is what excites an investor. It is not necessary for you to be a DIPP registered startup for you to raise money. Of course it helps, but it is not the only thing that is required.
Okay. As we have provided a lot of services, and now we have a database more than 1 lakh people, and they appreciate us a lot, and they are appreciating as uh, uh, they are recognizing as a unique concept we are giving them. But recently we have developed a product, 2 or 3 products we have developed. But yes, we have the fight for financially, so that's why I just want to go to investors. So would you suggest that how should I apply, and from where I should start?
First and foremost, you got to know what you're selling. Number one. Number two
Yeah.
is you got to have early traction, and then there is social media platforms. You can reach out to any investor via LinkedIn. There is incubators like Amity. You can talk to Vijay. I mean, prick his brain and see what is the traction, and he will be able to guide you in the first place. What is the next potential step for you? You require a business plan. You require any mentorship, and then you can approach an investor, have a discussion, get a constructive feedback, and see where you are from there.
Okay. Okay.
Nidhi, I have
Thank you.
sent my email in the chat box, right? All the
Sure.
startups
Sure.
can
I will.
send me their deck to my email ID.
Okay. Okay. I will contact you for sure. Thank you so much.
We'll unmute Vinita More now.
Good afternoon. My question is, we are developing a mobile app, which is basically to send out reminders for senior citizens because they just can't use Google Calendar or anything. And they're so overwhelmed and they forget that when their passport is due for renewal or once their FD is matured or something like this. So we have got the entire plan ready. We have got the UI UX ready. Then we got quotes and we were told that it'll be a couple of lakhs, but it's run into several lakhs right now, and we seriously are looking for funding. Also, we want to take this, we also want to develop one more app similar, which will be, side by side, which will be for the ladies because they don't look after the financial matters. So we want to start a movement where we tell that when your car registration is due, when your passport, you should be aware of it. You should be also aware of all your investments other than your husbands and brothers or fathers, whatever. So, this two side by side we are doing, and we have got very good response. As in, people are already asking, is the app ready? And it will come on Alexa, the reminders, whatever they want, WhatsApp, SMS. So we are pretty excited. We are a all ladies team of 5. We really seriously are looking for some funding, and if you could advise us how to go about it.
So, Vinita, thanks for your time and the question. See, with elderly people, I do understand that they have they tend to forget things, but but when you are asking them to put something on a Google Calendar, or for that matter, any reminder app, they have to be very mobile friendly or tech savvy to use the app in the first place. Somebody has to feed in the data where the reminder kicks in. So you need to see how you're going to make them use the app. That is the first thing. Or the second thing, initial product development, even if it is outsourced, you need to control all the costs. I completely see a lot of startups getting outsourced people to work on their apps, and there is time delays because very often you don't have a techie on the team who can understand what they're doing. They will extend timelines. You will end up, it will end up costing you a bomb, and you miss the timelines of a launch. So you got to be cognizant of this fact. The third piece of the question was on the ladies thing. So there are a lot of digital locker startups that have come up. There is a lot of uh, uh, awareness apps that have come up where financial literacy is one of the core fortes. If you want, there is a specific VC for female founders. It's called She Capital. Anisha from Idala has started this.
I missed that. Can you just repeat that?
She Capital, SHE, She Capital is started by Anisha.
Okay,
I
thank
think
you
she
so much.
is, yeah. So you can reach out to them. Happy to look at your model, but again, I mean, there has to be an MVP, which is the minimum viable product for us to look at a serious investment proposal.
Okay, thank you so much. This was really helpful. So I'll do connect with them.
Vinita, we have shared the details in the chat box for you to get any kind of access to us. Sure.
Okay, I'll mail. Yeah, I've got the email ID.
Sure,
Thank you so much.
So before next we have Mr. Praveen. Mr. Praveen, can you please unmute yourself?
Praveen, you're not audible.
I think he's on a patchy line. His voice is breaking up.
Well, we'll ask Miss Mansi to unmute herself.
Hello. Hello.
Yeah, we can hear you.
Hello. Good morning, sir. Myself, Mansi Sharma. I'm the founder of the Manukrishi Private Limited. So I started a firm regarding in agriculture. Hello.
Yes,
Hello.
you're audible.
We can hear you. Go ahead.
Yeah. So we started the difference between the traditional feeding practice and the right feeding practice concept. And also we are working for novel and cost-effective veterinary feed supplement for cattle.
Okay.
So right now we are making for a heifer stage, and we are going doing some trials and all. Right now we are only on initial stages. So I have a question. So I have to register the IP after all the experimentation done, or I can drafting the IP right now also.
Mansi, you can initiate the process of filing for a patent immediately. You can first apply it on the Indian platform. They will publish you a provisional patent, and if it is defensible, of course. I'm not sure whether you're applying for a product, process, design, or utility patent. But if it is a product patent, I suggest that you can go ahead and put it in the Indian forum first, see whether there is competition or not. And then later, once you have traction and a little more money to spend, then you can go for a global IP, which you can file with the US guys.
Sir,
yeah, go ahead.
There is one more question. Actually, my prototype product was ready. So the prototype product is ongoing trial and doing some pilot trials. So I need a funding for that. So I can approach on which institute, and what is the right way to approach the institute and pitching my idea.
Edison, let me answer this. Okay. See, in fact, a lot of ministries have come out with the schemes. Like Ministry of Electronics and IT has come out with a Tide 2.0 scheme where 51 incubation centers are spread across India, which are supporting startups at a prototype stage. Prototype funding support is up to 7 lakhs. That is dedicated only for the prototype development. So I suggest you just get in touch with the Tide centers. We are one of the Tide center also. You can share your tech with us. We'll help you out. Okay.
Okay, sure, sir. Can you give me your mail ID so that I can share the ideas and the pitch with you?
So
Refer to the
I'll do
show.
one thing. I'll share the link where you can directly apply. I'll
Yeah,
share the
sure,
link.
sure.
So
Kumesh,
meanwhile, we'll just
Kumesh
take the
Patel.
next question.
Kumesh Patel can be unmuted.
Yes.
Yeah, good afternoon, sir. First of all, I would like to thank MIT Incubations for arranging such a wonderful session with you. We are getting such a good knowledge as being founder to listen to the angel and VCs who are looking after the so many like startups and exist and that. So, sir, my question is like, okay, like as being a founder, there is one question every founder has, like, what is the right time to raise their first check? Like when it comes with the like starting with the pilot run and early tractions and like ups and down with the startup financials, what is the right time when they must feel ki ha, this is the right time when they can go and pitch to for early seed or the first angel or the first check? It will be a great thing if you guide us through that particular thing.
Good question. I think this is the best question that I heard. So see, fundraising is a relay race for investors as well. I'll be very candid with you. When you start up, the first objective is not to raise money. The first objective is to build a product or a service where you can control the business till it is IPO. That is where you create the maximum amount of wealth for yourself. But however said and done, a particular startup or a company will require funding at various stages. It may or may not be readily available, but that is how life is. When you are starting up, the best validation is from friends and families, when whichever way we look at it. So you can raise a very small check when you start up, where your product or your business plan is just coming up, or you say that I'm going to do this, can you back me? Your friends and families are the first people who will be able to back you. You can raise a very small amount, which you should utilize in a way to produce the MVP or the prototype. So you got to be really, really prudent on how you use that money, because that is the first, I would say, seed money that anybody can get, because it comes with a lot of trust factor. Once you have that MVP, there are plethora of VCs, a lot of people like us, angels, who will first see the product, and by that time, if you are doing something right, you will have traction as well. Believe me, there are people who start from a garage, and within the first 6 months they have sales. So if you're pressing the right buttons, you will get a VC at that stage, or maybe a very strong angel. There is a great angel network in India now, where people can write you checks up to a crore. In order to absorb that money, see, a crore fundraise is almost like 8 lakhs a month, which you can spend. And if you do that, and you have to be a little frugal, you have to be a little prudent of how you use the money. And from there on, it is a pre-series a series A, a series B, a series C, a series D, and an IPO potentially. A lot of people do series E as well, where private equity players come in. So that is the value chain of raising funds. There is a method to this madness. When you start, you get validation from your friends and families. Raise as much as is required. Don't go bonkers and say, I need $1 million in day one. That does not happen. There's a lot of pitches we get. They write $3 million, $4 million. $3 million is 20, 22, 23 crores. If you are spending more than 1.5 crore a month, then you will get to about 118 crores a year expenditure. If you spend that money, what are you generating out of that money? I mean, you want a team on day one? I don't think so. If you are saying to me that you want other people to work for you, you are not an entrepreneur. If you have to do a lot of work yourself, you've got to know the nuts and bolts of your business before allowing others to come and check your nuts and bolts. That is how I look at it.
Thank you, sir, for this answer. And I have one more question, and that's related to my personal startup. Should I? Okay.
Yeah,
Please
I mean,
go
in the
ahead.
interest of time, I would suggest you route the startup via Vijay. I think he
Yeah.
can screen it, and then we can talk later one-on-one.
Yeah, sir. Actually, the Vijay sir is being with me from since I started. Since I started my this brainchild to like whatever we survived till first year. So it's like my question is all about in all the VC race or angel race. All the angels and others are investing in tech or the tech based startups. But my thing is into the more social planner, like the mental health. Do I have future in India for the same to raise my first check?
See, even I got your question. See, it is not about whether you are tech or tech enabled, or there is any problem with the sector per se, because depression is a problem in India. A lot of people are depressed, they don't show it, or the people who are don't even go take medicine. So mental health is an issue, and of course, COVID has not. A lot of people are there who have suffered mentally a lot in terms of trying circumstances. So there is a potential. It's how you connect the dots. I mean, you're putting the cart before the horse. You first identify a problem, try and get a solution, try and sell that solution, and then see whether you're able to raise the money or not. I am a firm believer that if you're doing the right things, the money will chase you. You don't have to chase that money. But if you're not doing the right thing, then of course you will have to uh, see and check and prod where you're going to go this.
Yeah, sir. Because many of the investors to whom I pitched today till date, most of them are not interested in this particular domain. Like they are like these don't have future.
See, mental health is an area which will grow. It is definitely maybe in the Indian context, the investors you have reach out to guys who look at health tech, reach out to guys who want to look at a different sector per se. So see, getting a no for an answer is not where you stop. You got to first do research, see which all investments have happened in this particular sector, India as well as global. Who are the people who have backed it? Who are the angels? Who are the VCs who have put money in this business? Whether there has been traction or not, whether that money has been utilized properly or not. And then we can say that there is interest or not, because uh, there has to be some research before you approach. I mean, you cannot approach a person and ask him questions to give you an answer. You should find most of the answers yourself and then go with a specific query.
Thank you, sir, for your answers, and I will thank again to Amity and you.
Thank you.
Thank you, sir.
Thank you.
We have a next question from Ashmit.
So thank you so much, everyone, for giving this opportunity. And so I'll just give a basic overview of what we have currently ready. We have the MVP ready, and my question today would be: so if you have an MVP ready, what do you exactly mean by early traction? Is it directly selling the product in terms of monetary, or it's kind of the validation from feedback or review when you have an MVP ready?
Thanks, Ashmit, for the question. And this is one of the questions we also get. So by early traction, what we mean is, if you have created the MVP, any product has to be bug tested. You need somebody to use it. And when I say somebody to use it, it can be a paid POC, it can be a free POC, it can be a paid client, somebody who wants to use the product or the service. That is what early traction is. You may get just one, and that is good enough. Because at the end of the day, the efficacy of the product, we are talking about vaccines, and we're talking about efficacies of the vaccines. Everybody is scared that whether this is going to work or not. But there are people who are taking it and using it, and some of there is side effects, and some are just okay with it. So that is what traction is. Traction is getting somebody to use your product. You may create the best product, but there is no usage, it is no traction. That is what traction means.
All right, sir. Thank you so much. So, like, we actually have two customer segments. One is the client segment, then one is the user. So, like, user and the customer. So, is it has to be from the both ends, right?
Not necessarily. If either party is using it, that means that there is need for it. It can be the client or it can be the user. User would be a B2C play. Client can be a B2B play. There is a B2B2C model in play. Your app can work on one end and create traction, and that is good enough for an investor, as long as you join the dots together.
All right, sir. Thank you so much.
Yeah.
Sahil, some questions are there in chat.
Okay, so I'll just go through these questions.
Anubhav Sharma want to, can you unmute? Anubhav and Shivam are there.
Good morning, sir. Sir, I am audible. Am I audible?
Yeah, you are audible. Please go ahead.
Yes, sir. So, good morning, sir. My question is I am building a platform for all the content creators of all formats, whether it be images or videos or reels, to monetize their content as they do passively on YouTube. And to pump in money onto our platform, we are using the source of e-commerce. We are looking for e-commerce to pump money into our platform so that we can remain our profits and distribute the remaining money to those content creators. So, sir, the e-commerce part is the later part of our business. Then we gain a minimum amount of audience on our platform. So, sir, what I'm asking is, what will be the correct way for me if I look for angel funding, the correct way of valuation of my startup at an early, because I'm not generating any money.
Correct. I got the point. See, there are two facets of this business. One is the content creators. So you got to aggregate content creators because that is the core product you're going to sell. So you need a lot of content on your platform in the first place, as well as content creators who are making this content. Because once you're trying to sell this content, you need their consent. You cannot sell a content without a consent. Secondly, when you are curating that content and you're moving into a monetization piece, the content, whoever is paying for that content must share a percentage revenue with you. That is where you monetize it. And then, of course, advertisements will run at the sides because once there is traction on the platform and people are coming for the content, there will be obviously advertisements that will generate a lot of revenue. And then potentially later on, once you tie up with the brands, who will want to use the content for their own brand recognition, that is where you make a little money, have long-term contracts on the B2B side. So that is how you typically monetize this kind of a business. But when you're trying to raise money, you got to see what the competition has done so far, who are the people who have backed such companies. And of course, you need to be approaching platforms. Maybe talk to Vijay at Amity. There is Indian Angel Network. There is Lead Angels. There is a lot of angel networks, Venture Garage, Venture Catalyst, Let's Venture. There are multiple platforms where you can go and showcase what you have done so far, achieved so far, and see if there are early backers for this particular type of business.
Okay, sir. So, so much.
We have a next question from, I think, I'll check the chat. We have a question from NK. How to protect the idea at the initial stage and how to monetize when you're not charging from the B2C customers.
Sahil, can you repeat the question?
So the question says that how do we protect an idea at the initial stage and how can we monetize when we're not charging from the B2C customers?
Protecting an idea is a very, I mean, if you have created something good, I would suggest that you share it with people whom you trust and see to it that you create quick and early traction. It's very difficult to protect something. And you will not, I understand in terms of core technology or something which you have done very uniquely, you want to keep it hush hush. But at the same time, you need people to use it in this. So it's a catch-22 situation. I am a believer that you try and try and make sure that you go fast and you go first, and try and see that you have enough first mover advantage. You cannot protect too many things until unless you have money, and then it's a most businesses are not patent oriented businesses. If you're doing a services business, it can't be patented because many people will be doing it. If it is a product business, you have invented something, then of course there is defensibility of that business. You can go and apply for a patent immediately, get friends and families to pull in money and go for a patent in the first place, and from there you can see how things go. And what was the second part of the question?
How can we monetize when we're not charging B2C customers?
Okay, how can you monetize when you're not charging B2C customers? That's the typical fallacy. Then you start ending up paying money like cred or or khata book, where you're not making enough money, you're burning investor money. So early adoption is a risk for B2C models. They will have to rely on significant traction where you can open up ancillary revenue channels, which is advertisements, which is Google AdWords, which is other subscription based services. But of course that remains a challenge area when you're not able to charge a B2C customer. Even the likes of Uber and delivery guys like Zomato and Swiggy have now taken a significant portion of their commission a little upwards. You need to make money somewhere, because gone are the days where investors will keep giving you money to build traction. It's not how it works. It's very difficult business to sustain.
I think that is all for today in terms of questions.
Okay.
Before we leave, I have something to share with the audience. I'll just share my screen. So as a part of the A to Z startup investment series, we have two more events in the following weeks. We have the art of pitching to an investor by Mr. Dhruv Nath, and then we have term sheets for early stage startups by Mr. Jay Gandhi. So we'll be sharing the updates on our social media platform. So you can just subscribe to our social media handles for the updates. Thank you.
Thank you, Sahil. Uh, Thank you, Edison. I think it was a very informative session by you, and audience would have got an idea about what valuation and fundraising process is all about. I'm sure they might have some questions. Let them share those questions with with us, and we'll share it with you for more details. We'll connect you.
Sure, Vijay, thank you so much for giving the opportunity, and it has been lovely interacting with all the people on the session. Would love to come back and do more sessions with Amity Innovation Incubator.
Have a great day, everyone. Take precautions. Be safe. Thank you. Good day. Bye.
Thank you, sir.